Welcome to The Explainer. Today, we're going to pull back the curtain on a technique that really separates the pros from the rest of the pack: multi-timeframe analysis. We're going to break down how to see the market not just from one angle, but across its entire complex structure.
So here's our game plan. We'll kick things off with a super common mistake. Then we'll build up to the professional's framework and a system to actually apply it. After that, we'll see how it all works in the real world. And we'll wrap up with the one golden rule you've got to remember.
All right, let's dive right into a really common trap. It's this habit of focusing so intensely on the little details that you completely miss what's actually going on.
And I have to ask you, does this feel familiar at all? You've analyzed every single tick, every candlestick on your favorite chart, but for some reason, your trades just aren't working out. You might be staring this exact problem right in the face.
This analogy just nails it, doesn't it? Sticking to one time frame is exactly like looking at a famous painting with a magnifying glass. Yeah, you can see all the tiny, intricate brushstrokes, but you have absolutely no idea if you're looking at a portrait or a landscape. And that total lack of context? It's a recipe for disaster.
So how do we find that missing context? We build a framework, and this is the professional's solution, the time frame power pyramid. It's a way to bring a clear, logical hierarchy to all of your analysis.
The very first thing you have to understand is that not all timeframes are created equal, not even close. They each carry a different decision weight. So, look at the monthly chart. It holds a massive 50% of the authority. You can think of it as the CEO of your analysis. What it says goes, period. As we move down to the weekly, daily, and then the hourly charts, you can see that authority gets smaller and smaller.
You see, pros use each time frame for one very specific job. The monthly chart, it has supreme authority, and its only purpose is to tell you the major trend direction. Then, the weekly gives you the context for your swing trade. The daily, that's where you start hunting for a specific setup. And the hourly, that's just for nailing down your exact entry time. The process is always top-down.
Okay, now that we have the hierarchy down, we need a repeatable process to apply it. Pros don't just wing it, they use a system. And one of the most powerful methods out there is called SEPA. SEPA is this simple but, isn't an incredibly powerful acronym that basically acts as a checklist for your analysis. It makes sure you've covered all the critical angles, from that big picture structure all the way down to the final confirmation. It stands for support, entry, profit, and activity.
So first up is S, support. You use those big monthly and weekly charts to find the major decision points. These are your battlegrounds. Second, E, entry. You drill down to the daily or even the 4-hour for your precise timing. Third is P, profit. Here you use multiple time frames to set realistic targets. And finally, A, activity, which is volume. You use volume across all your charts to confirm that the price move is the real deal.
Now this all sounds great in theory, right? But what happens in the messy real world when your monthly chart is screaming buy, but your daily chart looks like it's about to fall off a cliff? Let's talk about how to navigate that uncertainty.
The best case scenario, the dream setup, is a green light. This is when every single time frame is in perfect harmony. The trend is clear, the setup is confirmed, the volume agrees, everything's pointing in the same direction. This is your signal to act with high conviction and use a full position size.
But more often, you're going to find yourself in a yellow light situation. Maybe the monthly and weekly charts are bullish, but the daily is showing some weakness. This is a clear signal for caution. It doesn't mean you can't trade, but the professional response is to reduce your position size and tighten up your stop losses. You're actively managing risk against that uncertainty.
And finally, we have the red light. This happens when there's a major conflict, like a bearish monthly trend but a screaming buy signal on the daily. So what does a pro do here? Absolutely nothing. They stop. They wait. Forcing a trade in a red light environment is just one of the fastest ways to burn through your capital. In this case, patience is the strategy.
And hey, if you ever start to doubt the power of this hierarchy, just burn this number into your brain. Monthly trends have historically steamrolled shorter time frames 80% of the time. 80%! Fighting that long-term trend is a really low probability bet. The big money, the major market direction, it almost always wins. You have to respect the hierarchy.
All right, enough theory. Let's see how all of this actually comes together in the real world. We're going to walk through a case study on reliance to see exactly how a professional applies these concepts from the very beginning to the very end.
Okay, so we always start at the top with the monthly chart. This gives us our primary directive. For Reliance, the trend is clearly up and the price is holding strong way above a key moving average. The analysis here is pretty simple, but the decision it dictates is absolutely critical. The market regime is bullish. From this moment on, we are only looking for reasons to buy. That's it.
Now we drill down one level to the weekly for context. And what do we see? Not only does it confirm the bullish trend, but it's forming a classic cup and handle pattern. And here's the little detail that pros look for. See how the volume is drying up during the handle? That's a textbook sign that supply is exhausted, sellers are giving up, and that suggests accumulation is happening. So our decision now is to get ready for a potential breakout.
Okay, finally, we move to the daily chart for our entry. We see a tight flag pattern forming, another classic continuation pattern. Indicators like the RSI have pulled back, which means they've basically refueled and have plenty of room for the next move up. So we've gone from trend to pattern to a precise entry point, a breakout above 2,780. The only thing left is to execute, but only if we see volume expand to confirm the move.
And the result? A clean plus 11.3% gain in just 6 weeks. Now this wasn't luck. This was the direct outcome of a systematic process. The monthly trend gave the direction, the weekly gave the context and the pattern, and the daily pinpointed the entry. It was a perfect green light setup, and it was executed with confidence.
So as we wrap this up, let's just boil all of this down to its most essential, most powerful form. If you're going to remember just one thing from this explainer, this right here is it.
These are the principles of mastery. First, respect the authority of the higher time frame. The boss is always right. Second, wait for that beautiful confirmation cascade, where all the signals finally align. Third, adjust your risk, your position size, based on how much agreement you're seeing. And always, always remember the ultimate rule.
It all comes down to this one idea: context before execution. Never, ever pick up that magnifying glass until you've already seen the whole painting. Analyze the monthly, then the weekly, then the daily. Once you have your context locked in, then, and only then, can you start looking for your entry. Master this, and you've truly mastered the professional's edge.